What is the strike price of the Powell put? That is the big question, which I think most of us are asking today. Powell's comments earlier this week, I think, are still not going over very well, especially when you have other members of the Fed kind of doubling down, you could say. Certainly not rolling back Powell's comments, not undermining his comments earlier this week. Talking, excuse me, I kind of have a bit of an allergy problem today. Talking in the same vein about how, really we need to accelerate the taper. And why? Why would you accelerate the taper? Well, the Fed has said in the past the reason why the taper is so important is because they want to completely taper QE before they can ever think about raising interest rates. And so if the Fed is talking about accelerating the finishing the taper sooner than expected, that means that they're trying to leave open the door to raising rates sooner than expected. But you wouldn't know that if you just looked at the bond market, or at least it wouldn't be totally obvious to a layman looking at the chart of the 10-year yield that the Fed is talking like they're going to, be raising rates, because yields are absolutely in the toilet. I just checked the 10-year yield. Seems to have closed right around 1.355%. That's down over 10 basis points in one day. This does not seem like a market that is very confident in this idea that the Fed is going to raise rates. Rather, the bond market seems to think, much as I think, much as I've said, that Powell's never going to raise rates. He's not man enough to do it. He doesn't have the tolerance for it. He proved that to us back in the whole follow-up to Q4 2018. Powell pretty much guaranteed us he will never allow something like that to happen again. Powell flip-flopped back when he was hiking rates in 2018, going into 2019, exactly when the stock market was down about 20%. Depends on which index you were looking at, but it was right around the 20% mark, right around the level that Wall Street considers to be a bear market. Jerome Powell was clearly not going to allow a bear market on his watch. At least he wasn't going to allow it to be, he wasn't going to allow it to happen without trying to do everything he could in his power to prevent it from happening. Powell, as Fed chair, is totally committed to his dual mandate to maintaining low interest rates and high stock prices. Some of you might have been, confused or misinformed when you were in school. If you were taught about the Fed at all, you probably were taught that the Fed has a dual mandate to maintain low unemployment and low inflation, or sometimes it's phrased as low inflation and high employment. But you see, that's just not quite accurate. That's not the mandate that Powell sees. Clearly, you look based on his actions, he is targeting the stock market. He's not targeting employment. He's not targeting low inflation. And the bond market knows this. They're not so dumb as to believe the words coming out of Powell's mouth. The S&P 500 currently is a little over 3% down from all-time highs. And the NASDAQ is over 5%. So depending on which index you think that Powell cares more about, I would think he cares more about the S&P. The clock's ticking. I think we're going to hit these checkpoints along the way, 5%, 10%, and 20%. And each one of them, there is a chance that Powell flip-flops and he says, you know what, no, taper is done, we're going back to full QE infinity. And so far from pricing in Powell's sort of implied rate hikes, the bond market is pricing in rate cuts. Now, what does that mean when we're already at 0% interest rates, on the Fed funds? Does it mean they're pricing in Powell's, negative interest rates? I don't know if I would go that far. But it certainly certainly means he's not going to be raising rates if the bond market is to be believed. And I think it goes without saying, but the bond market at this point has a whole of a lot more credibility than Jerome Powell. Talk is cheap. The bond market has to put its money where its mouth is. When I talk about, the bond market says this, the bond market says that, I'm reading the prices. Okay, so that's the definition of putting your money where your mouth is. Powell all of a sudden starts waxing hawkish and yields plunge. What does that tell you? It says that everybody knows that Powell's a wimp. He doesn't have the stones. He's not a hawk at heart. He can't tolerate it. We don't know if his line at this time is 5%, probably, 10%, 20%, but he has a line. And when the stock market crosses that line, which is going to be pretty soon at the current pace, they're looking for that Powell, for the strike price of the Powell put. At some point, Powell's going to come in here and try to put a floor in the stock market. And that's what the bond market is pricing in. Low interest rates, lower interest rates than we have right now. The Fed doing everything it can to hold yields down. That's one way of interpreting this. Now, the other way of interpreting this, that somebody like Jeff Snyder would focus much more on, is that because when we're talking about what the bond market's signaling, we're talking about what is the bond market correlating with, and there's always going to be debates when it comes to prices like this, whether this is simple correlation, specious correlation, or if it's causation. And so somebody like a Jeff Snyder, who I have great respect for, though I don't always agree, but I respect him as someone who knows far more about this stuff than I ever will. I won't dedicate as much time as he will. I mean, this is his life, the bond market, pretty much. He would look at this and say, the bond market is pricing in lower growth, a collapse in economic growth, and thus a recession. But again, these things are going to line up, depending on how you want to phrase it. It all means the same things. It means that Powell is going to chicken out. He's going to go ultra dovish again. He's not going to continue with his hawkish streak that he tried to start this week. He doesn't have it in him. So bottom line, bonds are telling us we're going down a dangerous path, an uncomfortable path, a path where risk happens. Keep in mind what I said, must have been yesterday or earlier this week. This is not a market built on fundamentals. The stock market, I mean, or any of these markets, frankly, if you ask me. Real estate, none of them. But the stock market in particular, not built on fundamentals. It's built on jawboning. Okay, we're way extended above fundamentals. I'm a fan of market cap to GDP. I don't even know what it's at now. Could be over 200%. I don't know. Once you get past 150%, I stop paying attention to the exact number because you're so far in la-la land. The number doesn't mean anything. These companies aren't growing like this. A lot of these companies in the stock market, not even profitable. The reason why the indices keep going up and up and up is because people are confident that Jerome Powell has their back. And as long as don't fight the Fed. Don't fight the Fed. As long as the Fed is on your side, everything's golden. But as soon as Jay starts to waver a little bit, as soon as he says, you know what, maybe we need to accelerate that taper. And we all know what that means, accelerate that taper. Accelerate the taper so that I can start hiking rates. That's what he's talking about. If Jay's not being a team player if he's talking like that. And if that's the case, now's the time to get out of the stock market. Because if he actually goes through with what he's saying, that's going to be real bad. But Jay doesn't want stocks to go down. Not on his watch. If I were Jay Powell, I would have quietly retired at the end of my term here. And I could have said, and leave this mess that I created, or I shouldn't say that I created, that I helped grow, because this was already a very bad situation when he took over from Yellen, and he made it much worse. He made it much, much worse than it was under Yellen, and it's a big, nasty boil on the face of the American economy, and I would not want that festering boil to rupture on my watch. If I was able to keep it under wraps for 4 years, I'd say, you know what, I'm out. Leave this to the next guy, because that's what happened with Greenspan. Greenspan left, Bernanke took over. Bernanke is the one who we always talk about, who was, the guy in charge then who gets all the blame. And Greenspan is still remembered as, the maestro. Greenspan deserves, as much, if not more blame than Bernanke. I think that Greenspan is a much smarter person than Bernanke, but that doesn't mean that he's not at fault. If anything, it means he's more at fault because he knew what he was doing. And Bernanke, I'm less confident that he knew what he was doing. So we all know the flip-flop's coming. It's not a matter of if, it's a matter of when. And again, when it does happen, will it be too late? I mean, the thing is, the Fed is out of ammunition. What does he have to do? In 2020, Powell was able to cut rates. He couldn't cut very much, but he was able to cut. There was something there to cut because he had already raised rates for meager amount of time at 25 basis points at a time. What were rates at, like 1.25%? Well, he was able to cut 1.25%. That's more than zero. Right now, he's at zero. So what's he got to do? Negative interest rates? More QE? Because we've all seen the wonderful effects from the QE he's been doing already that he's trying to taper right now. I mean, I don't see the direct correlation, but I mean, the stock market, at least sentiment-wise, is very much helped by QE. Stock traders like QE. It makes them feel good about themselves. It makes them more confident in buying stocks. But when you're dealing with something as fickle as, the sentiment of stock traders and retail investors, is Powell going to be able to put out the fire? Depending on how long he waits to flip-flop and go, as hard in the other direction as possible, is it going to be enough to quell the panic? I don't know. The Fed is always playing with fire when they're trying to just manipulate people like this. Because you run the chance every time you do this and you flip-flop that at some point people are going to say, you know what, I don't believe you anymore. I'm not going to trust you. You betrayed me. And when that happens, when people are already selling, the selling's not going to stop. It might slow down a little bit, but it won't stop. And once people see that it doesn't stop and immediately reverse and, rip higher for a month straight, then there are going to be people who, the people who did bought into Powell's BS. They're going to go, you know what? He's lost control. We can't rely on him anymore. We have to get out while we still can. That's why they call it risk. Notice how markets become ever more dependent on Fed dovishness. Before, I'm old enough to remember when Powell was able to start hiking rates, and he completely. Well, I shouldn't say completely. QE had been ceased by the time Powell took over. Interest rates were at 1%. QE was frozen. I forget what the size of the Fed's balance sheet was. Powell started letting the balance sheet run off, meaning he was reducing the number of bonds on the Fed's balance sheet, essentially selling those into the market. And he was hiking rates. And the market didn't crash yet. But after a while of doing that, then we started to get the crash. And Powell flip-flopped. And he said, you know what? No. I'm going to stop hiking rates. He didn't cut. He said, I'm going to stop hiking rates. And then I said, well, what about the balance sheet runoff? Are you going to keep selling bonds? Or are you going to maintain the level of QE? Are you going to cease that too? And he said, no, balance sheet runoff is on autopilot. And then, oh my gosh, all hell broke loose. So it wasn't enough for Powell to stop raising rates at that point. So Powell had to stop the balance sheet runoff too. Then 2020 rolls around. And that calmed things for a while. Then 2020 rolls around. And there's another panic. And Powell, of course, what's the first thing he does? Cuts rates back down to zero. He cuts rates, and then he says, and that wasn't enough. He had to also restart QE, and we went into QE infinity. And it's been straight up ever since. Now, Powell is trying to not cut or not raise rates, but just start, saying, hey, and not let the balance sheet run off. He's not doing that at all. He's just saying, hey, let's slow the rate of growth of QE. And we're just barely into that. There's still QE going on. QE is, they're actively adding bonds to the Fed's balance sheet. The Fed's balance sheet is growing right now. And the market's throwing a temper tantrum. Because they need Daddy Powell to tell them that everything's going to be okay. Powell wasn't even able to get to the point of letting, the balance sheet run off, or, start hiking rates, or even talk about starting to hike rates, because he hasn't mentioned anything about really hiking rates. But it's just, if he's going down this path, eventually hiking rates is somewhere down that path, and we can't have that. And so the question is, even though Powell has given up the transitory label, he has said it's time to retire the word transitory. His only hope at this point, if he wants to flip-flop again, is that if he flip-flops, inflation magically stops on its own. The bet there being that it wasn't actually Powell's actions that was contributing to inflation, but rather it was purely the supply chain disruptions caused by the global economic turmoil, and that magically those supply chain disruptions get resolved in the next couple of months, and so therefore we're able to magically have the stock market to the moon once again, rapidly growing Fed balance sheet, and let's say sub 3% consumer price inflation. And so the stars kind of have to align now in order for Powell to get out of this scot-free. And he's got another 4-year term coming up. So he's not out of the woods by any means. So with that said, next week will be very interesting. We will have some bounces, certainly, but it'll be interesting to see if those bounces get sold. And if they do, how long will it take before Powell or other Fed agents are out trying to put out the fire, rhetorically? I don't know. We'll have to find out. But I will see you folks back here tomorrow.